Hey, what's up you guys? Welcome back. So I figured it's time for another video. And yes, today we are talking about the big financial news that's gripping the headlines these days, which is that the Fed has decided to raise interest rates again, this time by 50 basis points, which granted is lower than the 75 basis point hikes that they've done recently. But this is still bad news to the market because it means that it will be even harder to borrow money and this will cause the economy to slow down. But with this new rate hike, the federal funds rate is now sitting at 4 to 4.25, so 4.25%. And the Fed has also revised their estimates for the terminal Fed funds rate, which is the goal of where they want to raise the interest rates to be 5.1%. So basically, it's always a range, right? So you can think of this as 5.0 to 5.25%. Because it's always a range, right? And this implies that there will be at least 75 basis points in total of rate hikes left to go before the Fed says, all right, we're done, let's pause and let's hold. So this is also bad news because this means that the rate hikes will likely continue into 2023. And they might do another 50 basis points in February. There's no meeting in January, so the next one is on February 1st, I think. And then they'll do 50 basis points in February and then 25 at the next meeting, 25 basis points. Or they might do three 25 basis point hikes. But anyways, that's what happened. So for the rest of this video, though, I'm going to share my opinion on all of this. Now, as a disclaimer, this is not financial advice, so don't go investing off of this, all right? I'm not a financial advisor. I'm just some guy on YouTube. And I also recognize that I don't have a PhD in economics, so I'm just talking from an armchair economist perspective. So I figured throughout this whole bear market, we've all become armchair macro economists, right? So why not throw my opinion out there? If you are an economist, though, and you're an expert on all of this, and you think I said something wrong, please let me know down in the comments why you disagree with me or why you think I'm wrong instead of just being like, hey, you suck. Right? Like, that's not helpful. Let me know why you disagree. Anyways, with that out of the way, what do I personally think about this whole rate hike plan from the Fed? Well, I've actually made another video before in the past where I said my opinion, and I'll say it again pretty much. My opinion has not changed. I really think that all these rate hikes from this point forward, including this current one, will be looked back upon as a mistake. And the reason why is because inflation is actually falling faster than economists have even predicted. The consensus estimate for the November CPI in the US was 7.3%, and we came in at 7.1%. Core inflation, which excludes food and energy, also came in lower than expected. Yet, we're also seeing massive layoffs at companies already. So right now, a lot of the layoffs are concentrated in the tech space, which, no one cares about because those people aren't hardworking anyways. They're not blue collar people. They're just, espresso drinkers or whatever. They're not like the blue collar workers that make up the backbone of the economy, right? Well, if that's your opinion, then fine. But this will spread to blue collar workers too. So we're seeing massive declines in the real estate industry, and that trickles through to a bunch of stuff like construction, right? And just transportational industries and moving raw materials around, like production of just from raw goods to manufactured goods. Those are all blue collar stuff, and if the real estate industry goes down, it's going to take down a lot of that with it. So if you look at the financial reports from real estate industry companies like RH Furniture, Toll Brothers, which is the builder, and companies like Redfin and Zillow, those reports are concerning and the guidance is awful. And Opendoor might go bankrupt. Not even kidding. Just look at their stock chart. They're a penny stock now, right? So not financial advice again, but I think that all these real estate stocks are toxic at the moment, and I don't see real estate getting better anytime soon. In fact, I don't think real estate has even bottomed yet. So I wouldn't touch real estate or any real estate stocks with a 10-foot pole right now. So we're seeing the devastating effects of rate hikes already, and it's commonly accepted among economists that the full effect of the rate hikes are only felt about 6 months after the rate hike. This means that if the Fed stops raising in, say, March of 2023, like if they follow the plans that they laid out and raise 50 basis points in February and then another 25 in March, then you won't really feel the full effect of it until September of 2023. And by that time, if I were to guess, the economy would be in real trouble. So the economy of the United States is no longer capable to operate properly at a 5% interest rates. So maybe 50 years ago you can, but not right now, not with $31 trillion of national debt. So I'm not saying that this means that the Fed won't raise to 5%. I'm actually believing them when they say that they will raise to 5%, but that's going to destroy everything, and that's my point, right? That's where my concern is, and that's why I kept on calling it a mistake. And furthermore, they're not going to be able to hold it at 5% for that long anyways. So it's like when you're pulling yourself up at a pull-up bar. If you're relatively fit, you should be able to do a couple of pull-ups, right? And if you're fit, you should be able to also hang there for 10 seconds or so, or 30 seconds. But the question is, how long can you hang on for, right? Even if you're a professional athlete, even if you're, I don't know, a bodybuilder, can you hang there for an hour? I don't think so, right? And the Fed can probably take interest rates to 5%. But how long can they hold it there? That is my question, right? It's like when you're trying to hold at a pull-up bar. Even when they finally reduce interest rates to their longer run target of 2.5%, which is what they aim for, will they be able to hold it there? So you're telling me when the unemployment rate hits 15% and the Fed is still at 2.5% federal funds rate, they're just going to be like, hey, we have a plan, we're going to stick to it. Forget about helping the economy. We're just going to stick to our plan. No, they're going to cut rates down to zero again, like they always do, right? And it's just a matter of time because remember, the Fed has two mandates. So number one is full employment and number two is stable prices. In practice, this means around 3% unemployment and around 2% inflation. And right now the issue is that inflation is too high and unemployment is kind of still very low. But if you really force the Fed to choose which one is more important, whether they want low unemployment or low inflation, their first mandate is low unemployment. So if unemployment hits like 20%, then the inflation rate doesn't really matter anymore because they're going to have to help the economy, right? So because 20% unemployment is much worse than 10% or 20% inflation. And again, right now the Fed is raising interest rates because inflation high and unemployment is low, but I guarantee you it's not going to stay this way. So unemployment will go up and it's already going up and it's going to take a while for it to come through. So my point is that we're going to be staring down the barrel of skyrocketing unemployment very soon, if not already. And worse, the Fed is actually steering us into skyrocketing unemployment, and they're not going to realize it until it's too late. It's like they're driving a train and the bridge is broken and we're going to fall into the water. In that case, when the economy is in real trouble, they're going to lower the interest rate back down to zero. And it's not going to be a staircase down being like, hey, let's cut 75 basis points per meeting. No, when they lower interest rates, it's going to be like the same way that they did in 2020, right? One meeting from 5% straight down to zero or something like that. Or maybe they start it lowering slowly, but then the economy really breaks and then they'll have to lower by hundreds of basis points per meeting all the way down to zero. And it's going to be an elevator down. And they're going to have to print money again. And we're going to be in the exact same scenario as 2020 to 2021. We're going to be in a speculative bubble. And that's generally not good, right? And it doesn't have to be this way. The Fed is raising interest rates to tackle an inflation problem that no longer exists. So if you look at gas prices, they come down a lot. This might be due to a variety of reasons, like the economy slowing down in other parts of the world too. But regardless, the world still runs on oil, and declining oil prices is very disinflationary because oil affects everything, right? So even for core CPI, which strips out energy, you can never fully strip out the effects of oil prices because everything you buy is shipped using oil, and all the services that you use probably relies on another service that relies on oil in some way, shape, or form. And side note, by the way, anything above 2.5% federal funds rate is generally considered to be restrictive. Restrictive just means that they're putting the brakes on the economy. So 4.25%, which is where we're at right now, is very restrictive already, and 5% is, of course, even more, up there. So in my opinion, I think the Fed should just pause interest rates right here. I'm not saying that they should cut right now. Obviously, they shouldn't cut right now because inflation, they really want to stamp it down, right? But since they've already raised to 4.25%, I think that's good enough. In 6 months, when the full effect of these interest rate hikes are known, then they could decide at that point if inflation is still a problem, and if inflation is still a problem, they can raise an interest rate. They could do another interest rate hike again, and I highly doubt it will be a problem 6 months from now, by the way. So that's my opinion, but obviously the Fed's not going to listen to me, right? Anyways, the last point I want to make is that we should really be questioning the wisdom of using interest rate hikes to solve a supply side issue anyways. So to me, this whole year seems to be like an issue where if your car engine is overheating and you're trying to fix it by smashing it with a sledgehammer, right? Like, yeah, it'll stop your engine from overheating if you have no engine anymore. Like that is one way to solve the issue, right? And isn't that what the Fed is doing, right? So it's like, oh, grocery prices are skyrocketing because there's less stuff to go around because the supply chain got disrupted because of COVID or, variety of reasons like conflict in Ukraine as well. You know how we solve that problem? We solve that problem by getting you fired so you can't afford groceries in the first place because you have no job. Yeah, you can't bid up the price of groceries when you can't even buy groceries in the first place, right? So that's one way to fix a problem, but let's question the wisdom of, is that the best way to solve this problem, right? And in my opinion, I would say no, right? But I don't know what your opinion is. The Fed is, of course, again, not going to listen to me, although I'm not the only one with this opinion, by the way. As I mentioned in my last video, people like Elon Musk and Professor Jeremy Siegel from the Wharton School of Business have also been saying the same things, and the Fed is not listening to them either, right? But to end this video on somewhat of a happy note, the more they raise interest rates, the more the economy is going to be smashed, which means that the more they'll have to help the economy later, and they're going to have to keep rates lower and print money for longer when it becomes evident that everything has been smashed. So the actions of the Fed today is setting up for another huge speculative bubble, in my opinion, in the future. And again, this is generally not good, but it might be good for you if you're holding on to assets like stocks, crypto, whatever, like real estate, things like that, right? So yeah, it might be a good thing for you if you're accumulating assets at the moment because you're setting yourself up for a glorious bull run, you might say, right? So if the Fed does get to a 5% Fed funds rate by March of 2023, I really don't think they'll be able to maintain it for even a year before massive rate cuts, right? So right now they're talking tough, and Jay Powell in the speech is like, we're not even going to consider the rate cuts in 2023. So, it doesn't seem like the market is really believing that, because if you look at the expectations in the futures market for the federal funds rate, or in the bonds market for the federal funds rate, it's much lower than 5.1%, like what the Fed is saying. Anyways, that's just my opinion. And again, feel free to disagree with me. And if you do, please leave them down in the comments and leave a, respectful, polite disagreement. Hopefully that's not too much to ask, okay? So anyways, please give a like if you enjoyed the video and consider subscribing if you like the series. Be sure to follow me on Twitter, and my link is down below in the description. Yeah, that's it for this video. I'll see you guys in the next video. Bye-bye.